Hi, this is the April 1st edition of Managing Risk Now. My name is George Dagnino. I'm the editor of the Peter Dac Portfolio since 1977, a long time. An important aspect in managing risk is to avoid investments that perform poorly in the current phase of the business cycle. Let me show you what I mean. In the February edition of Managing Risk, I showed you how the business cycle works, and its ups and downs and ups again is just a response to business decisions to manage profits and to manage cost. Right now, the economy and the business cycle started slowing down in 2018 and has been slowing down, and we are in this part of the curve. And what we have been experiencing, as I will show later, we are still seeing the same behavior from the markets as we should expect during this phase. And this is really the trick in managing risk of your portfolio. This chart shows the S&P 500 is the green line with all its wiggles and the latest sharp decline, and the 200-day moving average nice and smooth. In the lower panel, I show the business cycle as we computed basically every second, and it shows how the economy strengthened until early 2018 and how eventually it started slowing down since 2018. The main objective and the most important step in minimizing risk is that you don't want to be in the wrong sectors during this period, because you're going to suffer losses much bigger than otherwise you would have had. So let me show you what I mean. This chart shows the ETF for the energy sector, and in the lower panel is our business cycle. These are the mini cycles since 2010. What this chart is very important to minimize risk. This is what I mean. If the economy weakens, you don't want to be in an energy sector, because commodities are weak, because business produces less, there is less demand for commodities, so commodities go down. Therefore, prices go down and they lose money. So during a period of slower economic growth, the energy sector declines. During a period of economic growth, energy sector declines. During a period of economic growth, energy sector doesn't do anything. The energy sector does well when the economy strengthens, like here. Economy strengthens, energy sector strong. Business cycle strengthens, energy sector strong. Friends of mine say, gee, but we buy Chevron, Exxon, they're great companies. Yes, that's fine. They're great companies when the economy strengthens, but not when the economy is weakening, and they're losing, of course, a ton of money. I can't explain it. This very simple business relationship between commodities and energy stocks is the same thing, and the business cycle. The point is, again, to minimize risk, portfolio risk, by investing in the sectors that are doing well during that particular phase of the business cycle. This is another example. Industrial stocks ETF is XLI. XLI, the industrial stocks, when the economy slows down, they don't go anywhere. You buy industrial stocks, which are sensitive to economic growth. When the economy strengthens, they go up. When the economy strengthens, they rise sharply. When the economy strengthens, they rise sharply. So again, the industrial stocks are not investments appropriate when the economy slows down. They are appropriate when the economy strengthens, and when the economy strengthens. You always hear that the financial sector is oversold and people should buy financial stocks. However, financial stocks follow closely the rules of the business cycle. And in fact, you will see financial stocks strong during a period of rising economy, strengthening economy, but then they're weak when the economy weakens. Then they're strong again when the economy strengthens, and when the economy weakens, they slow down and decline. They are strong again when the economy strengthens, like in this period, but since 2018, as the economy weakened, financial stocks are not performing well at all. So people say, is they're undervalued? Well, they probably will become even more undervalued as long as the economy slows down. When would you buy financial sectors, financial stocks? When finally the business cycle turns and goes up again. Until that time, this is not a good sector to choose to invest. What I said for the financial sectors is also true for the transportation stocks or the transportation sector. Again, the transportation sector is strong during a stronger economy, like this period. They are weak when the economy weakens. They are strong when the economy strengthens. When the economy weakens, they roll over. The economy strengthens, they are strong. When the economy weakens, they roll over. So the business cycle is a crucial input to develop a strategy to minimize risk. Why? Because you don't want to be in sectors that perform poorly during periods of economic weakness. The same pattern that I showed before is also true for the commodity complex. A strong economy, strong commodities, weak economy, weak commodities, strong economy, commodity stabilized, weaker economy, commodities collapsed, stronger economy, commodity stabilized, weak economy, and here the sharp decline in commodities, crude oil, copper, and zinc, aluminum, all the major commodities went down. So the point is that if you want to minimize risk on your portfolio and you see an economy that is slowing down, you don't want to be in commodities or commodity sensitive stocks, for instance, Chevron or Exxon. I want to show you again a relationship that has been very, very important and I use quite successfully, and there's a relationship between the stock market, SPY, the S&P 500, and TLT, which is the price of long-term bonds. And this is a very important relationship to minimize the risk of the portfolio. You want to be mostly in stocks, that's why the ratio is rising, when the economy is strengthening. But when the economy is weakening, the ratio declines, which means that the bond prices are outperforming the S&P 500. Here the economy is strengthening again, and you see the S&P 500 outperforming TLT, which is long-term bond prices. However, when the economy weakens, you see this ratio declining, meaning that TLT is outperforming the S&P 500. Here again, the economy is strengthening, and the S&P 500 is stronger than the bond. You would not like to be in bonds. However, when the economy is weakening, look what happens here. Bonds have been much, much stronger than the S&P 500, and they provided a tremendous hedge for the overall portfolio. This is a very important relationship that has to be understood if you want to be a successful investor. The point of the presentations was to show you that there are very specific sectors that are strong during this time. And these are the sectors when the economy that outperform the market when the economy strengthens. However, when the economy weakens, I showed you in other videos that you have to shift the capital into other sectors, in other kind of stocks, to take advantage of the weakening economy. With bonds, again, let me say this very clearly, with bonds increasing as a percentage of your portfolio, because during this period, especially during the latter part of this phase of the business cycles, outperforming and be very, very strong. This is just a reminder that you can subscribe to the Peter Dag Portfolio, which is published every week on peterdag.com. First month is free, and then I published 3 books. I wrote 3 books that are available on Amazon.com.